On the morning of May 26th, the United States Central Command launched a series of self-defense strikes against targets in southern Iran, shattering an ongoing ceasefire in the region. Physical retaliation followed quickly. Iranian officials confirmed several heavy blasts echoing near the critical oil port of Bandar Abbas. Tehran heightened the military stakes with a specific claim. Their forces had successfully shot down an American MQ-9 drone. The political temperature spiked further when Donald Trump issued an ultimatum demanding the immediate handover of 400 kilograms of enriched uranium, or the destruction of Iran's nuclear infrastructure. A sequence of news like this typically signals a massive global financial crash. However, the Indian stock market remained calm. The Nifty 50 dipped only 0.49%, while Bank Nifty successfully defended its 55,000 support level. Several sectors even remained positive. IT, energy, and FMCG all closed with gains despite the headlines. This creates a mathematical paradox. Millions of investors watched the threat of a wider war unfold, yet the market largely ignored it. Market panic is rarely triggered by conflict alone. A crash requires a physical threat to global supply chains, specifically the flow of energy. This chart tracks the immediate reaction to the morning's strikes. We see Brent crude oil spike about 2%, reaching $95.66 a barrel. Wall Street algorithms are programmed around a specific ceiling. As long as oil stays below this $100 mark, the risk of runaway global inflation remains statistically low, and institutional systems are set to hold their positions. Even with the Indian rupee experiencing a minor devaluation to 95.68 against the dollar, the macroeconomy stayed stable because energy costs remained under that critical threshold. Beyond the price of oil, the market is protected by speed. Today, the vast majority of trading is executed by automated bots. These systems have been processing escalation data from the Middle East since March. Because this geopolitical friction has become repetitive, the algorithms no longer trigger a sell-off when they encounter familiar headlines. In this environment, human fear is filtered out by predictable mathematical logic. Shifting focus from the physical conflict in the Strait of Hormuz toward the skyline of Doha, Qatar, reveals a different set of priorities. While missiles were launching in the south, U.S. and Iranian delegations were quietly conducting backdoor peace negotiations in the Qatari capital. These talks center on the potential unfreezing of $12 to $16 billion in Iranian assets, providing a massive financial incentive for both sides to prevent a total breakdown. Reports of progress on a $16 billion deal offer a tangible signal of future stability. For institutional investors, this multi-billion-dollar diplomatic roadmap often carries more weight than the volatile optics of localized military strikes. Ultimately, global market confidence is driven more by the quiet movement of capital than by the loud exchange of missiles. On the ground floor of the National Stock Exchange in Mumbai, the day's activity told a very different story than the morning's news. The minor volatility recorded on May 26th aligns with the routine pressure of a monthly options expiry, a scheduled technical event that outweighed the impact of international warfare. Geopolitical headlines are designed to capture immediate attention, but they rarely dictate the long-term health of a diversified portfolio. For the everyday investor, the most reliable strategy is to ignore the emotional noise of the news cycle and instead track the underlying commodity metrics. As long as oil remains below its critical threshold and backroom diplomacy continues, the economic engine will remain resilient against the shocks of war.